The fact that you bought Safaricom even at 35 or 40 shillings, knowing that it is a solid company. You looked at the fundamentals and the fundamentals supported a price of 35 or 40, but we are trading today at 18. So you are asking, were the fundamentals lying to us? And the answer is no, the fundamentals were not lying to us, but we have an understanding, because we have come through this share hub class, that share prices are not only a reflection of the fundamentals. Share prices are also a reflection of the general mood of the investors out there in the market. If we are in a bad mood today and we are all deciding to sell our shares, whether or not those companies are rock solid, the prices will go down. If we're in a very good mood and we all decide we are bringing all our resources to buy shares, even for those companies that do not have good, strong fundamentals, you know what? The prices of those shares will also go up. So it is an issue of understanding that volatility, ladies and gentlemen, we promise you, will be there. That is one thing you cannot avoid. And the issue is what happens when volatility is hitting you in a negative way. How do you react with it? How do you deal with it? What are you supposed to do? Again, let's give the example of Safaricom at IPO. IPO price was 5 shillings. Like I mentioned, 2 to 3 years later, the price had gone down to 2 shillings or about 1 shilling and 90 cents. What should one have done? The fundamentals of Safaricom were only on an upward trajectory, but the share price was on a downward trajectory. So what do you do in a situation like that? If you have a good perspective on the market, and what is very important and how you deal with it is you buy more shares. Ladies and gentlemen, you buy shares as a rule. You buy shares of good, strong, solid companies when the share prices are going down. As a general rule, you buy as much as possible when the prices are going down, because what goes down will go up. And again, as another rule, and I talked about greed at the beginning and the avoidance of greed. When the prices are going up and you've looked at the fundamentals and they look overpriced, is when you sell, right? But volatility from a perspective of you've already bought some and the price has gone down. What do? The first thing that you do not do is panic and sell. Part of the reason why Safaricom price accelerated downwards after IPO is that, number one, people had taken quite a few loans to buy those shares, which is a very risky strategy, because there is no guarantee of price appreciation, but there is a guarantee that you must pay for the loan, right? So there is that mismatch of one is guaranteed, the other one that is paying for it is not guaranteed. So that's a situation you should generally try to avoid. So there was that issue, and that not understanding that when the price goes down, for as long as you understand the companies that you're invested in, you understand that this should be long-term investment, you understand the fundamentals are solid, and you should be buying more. But because there was lack of that understanding coupled with the panic, so more and more people sold and sold and sold, adding to more and more supply without the demand for it. And that's what continued to push the price down.